When you contribute to your employer pension or group insurance plan, do you know where your money is going? It's your money. You should know. In this episode, I speak to Ann Verlinden, CEO of PensioPlus, the Belgian Association of Pension Institutions. It's a recording from Belgium Money Week 2025. This was a fascinating conversation where I learned a lot. In this episode, you will learn about pension funds, what they are and how they work, how they are very different from life insurance products, and how well they've performed in the past few decades. I asked Anne about the cost of pension funds, their performance, and whether or not it's possible to have index funds in them. And I was in fact quite surprised by her responses. We also talk about what you can do to make sure you get the best pension products through your employer. So if you're interested in optimizing your pension income, this is a great episode, which complements really well the other replays from Belgium Money Week 2025. By the way, my name is Sebastian Aguilar. I'm the founder of Fire Belgium, where I help people in Belgium take control of their finances and learn to prepare for their pension through evidence-based passive index investing optimized for Belgian taxes. I explain everything you need to know to be able to get started on your own in the free workshop on the Fire Belgium website, firebelgium.com investing workshop. And now, let's learn from Ann Verlinden. Welcome everyone to the third talk of Belgium Money Week 2025. Today we're speaking with Ann Verlinden, the CEO of PensioPlus, about everything you need to know about Pillar 2 of the Belgian pension system. Ann, welcome. Thank you for being here. It's really a pleasure and honor to have you today with us.
Thank you very much. I'm happy I'm here. I'm happy I can create awareness around our pension system. And I hope that tonight we will give some useful information about pensions and more specific occupational pensions.
Yes, I think let's state the purpose right in front. We have a lot of people who are listening and watching this who are employees or self-employed, and they're wondering how Pillar 2 functions, how those pension plans work, and what they can do maybe with their employer or in the choice of that they have to basically optimize for their pension. And we'll cover a lot of the challenges of the system, but also we want to touch on practical things that people can do to improve their pension generally long term. As we were discussing before we started, I think I heard you say that you were in the industry for 30 years. Could you tell us a little bit how that is and how you got started and how you ended up being where you are?
Yeah, I am an actuary from profession. So when you start as an actuary, you immediately have to make the choice. Are you going to work in life or in non-life? Because it's often insurance linked, the work that's done. And at that time, I didn't know what to choose, but all of a sudden I got an opportunity to work, and that was in the life sector, so in pensions, and immediately in a company which was helping out pension funds to organize their system. So I have worked many years as an actuarial consultant in the context of pension funds. So I was very involved in setting up pension funds, in managing the administration, in doing the calculation of reserves, in calculating benefits, but also in doing asset and liability management studies. So the whole picture, the whole cycle of a pension fund. And then all of a sudden, I got the opportunity to start with PensioPlus. Today, I am CEO of PensioPlus. And who is PensioPlus? It's the association of the Belgian pension fund sector and also of organizers of an industry-wide pension system. And as such, I have to do quite a lot of work in the context of occupational pension, and then specifically in occupational pension organized by a pension fund. Perhaps I get the opportunity later to explain what a pension fund exactly is. But as an organization, as an association of that sector, we are involved in representing the sector. That's a very big part of our job. But also in informing our members, because we are a member association, as well as in setting up education sessions, because board members of a pension fund need to fulfill some fit and proper requirements, and we are offering them the Belgian Pension Academy, we call it, to make sure that they have the right skills to become a board member of a pension fund. And then the very nice part in the job is organizing the community, setting up discussion meetings, but also organizing network events so that people can meet each other, and that they can exchange know-how, but also questions, experiences, so that we can learn from each other. That's also a very important part of our job. As I said, the pension sector is not only ruled by national legislation, quite a lot of regulation also comes from Europe. So we are not only working at national level, but together with the umbrella organizations like Pensions Europe and AEIP, the Association of Paritarian Organization, we are also working at European level. So that's how I got with PensioPlus.
Yeah, so in fact, you are working in the background, making sure a lot of things are working well so that employees and self-employed who are contributing to their pension in Pillar 2 basically have good results, and that things are well managed in the background.
Yeah.
So thank you for the work you're doing because I think everyone is benefiting. At least close to like 70 or 80% of Belgians, active population, is benefiting from your work. So thank you so much. So maybe let's go back to this then. What is a pension fund and what's its role in like Pillar 2 of the Belgian pension system? And maybe before we go there, for those of you who are listening to something related to Belgian pensions for the first time, the first pillar is the government pension, is a pay-as-you-go system where we redistribute the contributions of workers to retirees. The Pillar 2 is a fully funded system where individual employees and workers contribute gradually in their career, and then at the end, then they benefit from what they've accumulated plus some growth or interests, and that gets distributed as a lump sum, as far as I understand. Is that correct so far?
Yeah.
Okay, so what's a pension fund and how does it fit within the rest of Pillar 2?
That's a lot to cover, but I
Yes.
will start with the easy part. What is a pension fund? In Belgium, it's an obligation if you organize occupational pension, and I will come back later to it. If you organize occupational pension, you can't put the provision for that pension, because it's a pension promise you make as an employer towards your employees. You can't put the provision of that pension on your balance sheet. In Germany, for instance, you can. In Belgium, you can't. And why can you not do that? Because they want to protect the employee for a possible insolvency of the employer. And they want to make sure that the pension promise that was made, that it can be executed by externalizing the provision for that pension promise. And in Belgium, there are two ways to externalize it. Either you go for a group insurance or you go for a pension fund. Basically, they are doing the same. They are both managing pension money, but the way they do it is totally different. A group insurer is characterized by the fact that he is insuring something. He makes a fixed promise. For instance, ideally, if the employer promises 100 at retirement age, ideally, the insurance company calculates the premium to give exactly that 100. And in that context, the employer is sure that once he has paid his premium, that everything is well funded and that he doesn't have to bother about additional liabilities. Of course, today we are working with totally different pension products, DC type of plans, where you put part of your salary, X%, 3%, 5%, 6%, whatever, where you are trying to invest it, and there the insurance company is working not with a fixed promise, but with a fixed contractual tariffication, so that in the end you know what you will get. And often today, that tariffication is not always enough to cover a legal minimum guarantee. But that's group insurance. I will focus on pension funds. Pension funds, it are not-for-profit organizations which are set up by the employer, but also often the employee, because often they are organized in a paritarian way to manage their own pension promise. For instance, and often it are American companies or companies from the UK, because that's where pension funds were invented, as we say. They already installed pension funds in the early 70s, 80s to make sure that they well manage the pension promise of their employee. And the big difference with the group insurance is that the pension fund is just there to manage. They don't make any promise themselves. They don't sell anything. They don't have products. It's a way to organize a pension promise which was made between employers and employees and which is externalized from the company's balance to be well managed in a paritarian way or solely by the sponsor to make sure that the pension promise in the end can be made. And what is typically for a pension fund, is that that the board of that pension fund and also the organizations which are behind it, that they have to set up everything themselves. What do I mean by that? They have to choose an asset manager. They have to choose an administrator to do the pension calculation, to do the pension communication. They have to look for an accountant to make sure that the annual accounts are made. So it's a whole package that they have to create themselves. And that's why not every employer is interested to work via a pension fund, because it's a lot of work. But of course, together with that work comes also the flexibility. They also have the responsibility. But in the end, they have a full say and full control of the pension money they want to invest to cover their pension promise. And the fact that all return is going to the members of the pension fund makes that often, although perhaps it are some percentages, it's much more worth or much more interesting to invest via pension funds than to go via group insurance, because there, of course, you're also paying for the marketing, you're paying for the shareholders, you're paying for quite a lot. But on the other hand, if you go for a pension fund, you also have the liability, you also have the responsibility, and you also need to do the organization. So it are both vehicles to manage pension money, but they are organized in a totally different way. And they also have their own regulation.
And so, if I understand well, as an employer, you can choose to go with a commercial entity like a group insurance company that will then have products I can readily use. Or I can decide to set up my own pension fund, which seems to be a lot of work and responsibility and time via the non-profit or the not-for-profit. I guess there's also the third option, which is to join an existing pension fund.
Well, today that's possible, but of course, you need to have a certain scale to do that. You can, so today there are commercial providers which are providing the solution of a pension fund, and which is a bit a mix between a full, true, normal pension fund and a group insurance. Because what we often see is that the providers who are organizing this for employers, for instance, force the employers to use certain asset managers, which are then linked to the providers. So yes, it exists, but it's not a pure form of a pension fund. It's something in between a pension fund and a group insurance.
And so for the people in the audience who are contributing through the Pillar 2 to either a group insurance or a pension fund, can they go to the employer and say, hey, I'd like to see what's going on. And then do they have a say in maybe advice or suggesting to change if they find out something is not so good? Like what flexibility is there once things are set up? Like I can imagine that the pension fund is hard to change because it's like the company is already invested, but the group insurance is something that's more easily changeable, or like is there flexibility really?
I think the flexibility for change is similar with the group insurance as with the pension fund.
Okay.
You don't do that overnight.
No, no, of
That
course.
that's really an important step to change a pension institution. But to come back on your question, what can I do as an employee? What can I ask as an employee? I would say you can ask everything. And I think perhaps you should ask everything. There are two types of pension plans common in Belgium, either the defined benefit type, where your pension promise is something like, I promise you at retirement age X%, 60%, for instance, of your final pay. It's a defined benefit. In such a type of benefit, an employer will allow you less to change things. Why?
Mhm.
Because there the employer is fully responsible to make sure that that pension promise is put in place and that the system is well funded to make sure that that pension promise in the end is respected.
Yeah.
On the other hand, you have other types, and those are the new types of pension plans, defined contribution plans, where the promise is I use 5% of your salary, for instance, and I withhold that from your salary. I put it in a group insurance plan or in a pension fund. It's invested, and in the end, at the retirement age, you will see what you get. And of course, you can try to calculate some expected benefits linked to a certain return. But in the end, there the employee bears the full investment risk of the pension plan. And especially in that type of pension plans, it's important that an employee asks questions about the investments, about the return, about the costs, because in the end, that will have a huge impact on his benefit, on his retirement benefit. And I think it's quite obvious that lately there are installed much more DC type of plans than the older DB type of plans. There was in the 90s there was a full switch of the DB type of plans to DC type of plans, but in a DC type of plan, typically employees should ask questions. And of course, there the social regulation, which is there to protect also the employees, gives you quite a lot of maneuver to ask those questions. You, as from January 26, you will get, everyone in the second pillar will get an affiliation document. For pension funds, that's already installed as of 2019, but in the future, everyone in a pension plan will get such an affiliation document in which you get a full picture of the most important characteristics of the pension plan, in which you get an overview of the returns of the latest 5 years, in which you get a standardized cost reporting. So there is quite a lot of information available upon affiliation. Of course, you always have the right to ask for your pension rule document, which is the legal document in which the pension promise is legally described. But as it is a legal document, of course, it's not always very readable to non-experts. And then, of course, you also get an annual benefit statement. Lately, it's available on My Pension, where you have a lot of information about, for instance, the retirement age, about the vested reserves that are those reserves which are already accrued at the moment, but also the vested benefits. So what you will get based on those available reserves in the end at retirement age, and either if you are in a defined benefit plan, then it's very clear what that benefit is. If you are in a defined contribution plan, there they will try to estimate these expected benefits, taking account of 3 plausible scenarios: a best estimate, a bad weather scenario, and a good weather scenario, so that you have quite a view on what it could bring at retirement age. There is also reporting on costs. There is also reporting on contributions paid. So that's information you get annually. And I think it's good, first of all, to have a closer look to these documents, but also in case something is unclear, to ask questions about it, because that's important that people understand what benefits are saved for them. It's so important that you know what to do to make sure that you have a decent, accurate pension at retirement age. And that's a responsibility. It was in the past a responsibility of our government. I think it much more becomes a responsibility of the government and also the social partners, because the second pillar, I believe, will get a much more important role in the future. But if the combination of those two for you as an individual does not seem to be enough, it's your individual responsibility to fill in the gap. So I think indeed it's important to have all that information. And then on top of the documents I mentioned, there is also another document, the transparency report, which gives you much more information on the underlying investments, on the underlying returns for the different type of assets, on costs, on that's more technical information, but nevertheless it can be interesting to have a look at. For the moment, it's still a document that you can have access to on request, but in the future, I believe as from 28, although I'm not totally sure about the date, it will become a document that also will be available on My Pension. So I think there is quite a lot of information, and we as an industry often say perhaps it's too much. It's not that we are against information, not at all, but sometimes we have the impression that people are a bit overloaded with all those documents, and that it would perhaps be better that you have 3 or 4 figures on one page with a possibility to be directed to further information. Sometimes, indeed, when it's about second pillar information, often it's too much on one page, and that can be frightening for some people. But I would say, please have a look at it, ask questions about it. It's important. It becomes more and more important. And I think the industry has invested a lot in these documents. So read them and please ask your questions.
Yeah, so in our community, a lot of people are financially literate because they're learning to invest on their own. And so hopefully this information there will be very useful to them to really get a sense of how it works within the pension plans. But I can imagine that for the majority of people, it might be just too much.
Yeah.
I guess this is something that will be improved. It's just like, just like the key ID document for investment funds, which are supposed to help the investors, but most investors don't understand what it means. And the information is in there is just presented in a difficult way to understand. But I guess this is it's gonna improve it. Certainly disclosure is helpful. It just needs to be done in the right way, and gradually we'll get there. But I can imagine that at first it would be tricky. Also, I guess one thing that comes to mind is, because pension funds have assets invested in the equity market, when there's a market downturn or market crash, it could be a little bit scary for employees to look at the numbers and be like, oh, well, it just went down. What happened? Without the understanding of what it means, that the money is there for the long term. And so even if it goes down a bit, it doesn't matter so much. So I guess there's a lot there. But I also see this disclosure as an opportunity for financial literacy and awareness and education. So if it triggers the right kind of questions, then people will learn, hopefully, then what it means. And so hopefully that moves in the right direction.
But that's a very interesting point you make. I hope that all this transparency doesn't push us in a more risk-avert way.
Yeah, that's the risk.
Because, yeah, Because of course, in our job, it's very important that we know that we are investing normally for more than 20 years. So we don't have to be scared about an annual return of minus 15. That's not what counts. What counts is that on the longer term, over the full career, we have a decent return.
Right.
And
Yeah.
their pension funds, we exist this year 50 years, and we started to take notes of the average return of the pension funds in the 50, I think, so 40 years ago, almost a full career. And there we see that the pension funds, as we are investing quite a lot in the real economy, more than 75%, we have an annual return of 6%. 6.2, I believe.
Mhm.
Even after inflation, it still gives a very decent net return of 3.9. So yes, it works. And we have seen years where we had returns of minus 15, minus 17. Luckily, it were exceptions, but those years exist. Don't panic in such a year. You have to look over the whole career period. And that's something very important to mention. When you put a contribution in your second pillar plan, you don't see it for many years. So it's so important that we do take that long-term investing seriously. But that means that we need to dare to take risk. And especially for younger people, I think it's a nightmare if they only invest in bonds and fixed income stuff. No, they need to dare to take risk and to make sure that the compound interest rates can do their work and do their job and can pay quite a lot, big deal, a big part of the final retirement income. That's the aim.
Yes.
And yeah, of course, that's very tough to convince people if you are on a board of directors. I had it a long time ago in my career where people had given up a salary increase or part of their salary increase to transfer it to contributions in a DC type of plan. And the first year the plan existed, the return was minus 10. Of course, that's not easy to explain to the workers. It were blue collar workers. So that's not easy to explain, and that's not easy for their social partners to still defend that type of plan. And there, I believe we really have a job to do to increase financial literacy and to make people understand that, yeah, that you need to look to the long term and that volatility is inherent to that type of plans and that type of investments.
Yeah, and
But
in this case, I can imagine that maybe not being too transparent is a better strategy, but it's difficult to decide which way to go. It is tricky. It is tricky. I can imagine the difficulty, especially when just getting started, convincing people that it's a good thing and then seeing it going down and then be like it's
but
really
never question the transparency. Make sure that people understand. But
it's
of course that takes time and
I think
that's a real investment.
it's even when people understand, I can speak as someone who's guiding investors, even when we know that we're investing for the long term. And even when we know that the money, that the market could go down the day after we invest, when it happens, even when we understand, it's still hard. Like
It's
this
tough.
is all
Yeah.
the time. And I mean, especially now in the past couple of months or so, it's a challenge for many investors who are managing their own money, despite knowing that this is happening every other year or so, that the market goes down for a bit. It's still difficult. So I can imagine that, yeah, imagining this on a larger scale with like the social partners and having this conversation must be difficult. So yeah, it is a very tricky job, in fact, to do this sort of work. But let's go back to this question of performance. You said that over the past 40 years, you have an average performance of 6.2%, so above 3%, above inflation, which is quite remarkable, I have to say, because I don't think the insurance products can can speak about such good performance. Is this information that's available for us to see somewhere?
Yeah. PensioPlus does such a survey amongst their members every year.
Okay.
We do that at several moments of the year, but we always have on an annual basis a big financial survey with where and the results of that financial survey are presented on our annual financial seminar, which is often in the month May. You can find all the documentation of that financial survey on our website. So yes, on top of that, we always do a press release early in the year. I think this year it was somewhere end of February, where we go to the press with the results of the past year. So yes, it's available on
Mhm.
our website and on the public part of our website. Yeah.
Okay. Okay. We'll check it out. This is really interesting. We mentioned as well the question of asset allocation, so that it doesn't make sense for young people who are still working for many decades to have all their investments or savings in bonds. And this is one of the main criticisms that I have of Pillar 2, because on average, Pillar 2 is mostly insurance products, a lot of Branch 21, and even in Branch 23, there's a big chunk that goes into fixed income and bonds, and basically products that are not necessarily the best in such big proportions for very long investment periods. I understand that for investment funds, that's not necessarily the case because you were saying that 75% is invested in the real economy. Does that mean equity then directly?
Not only equity. We invest about half in bonds, and half of the half is government
Yeah.
bonds. The
And the
other
other half
half
is,
is corporate bonds,
yeah.
and then the other part is equity. And equity often a very small part, infrastructure, private equity, but that's really a
Mhm.
limited percentage, about max those alternatives max 10%, not more.
So what drives this decision of allocating those assets in this way?
Well, we are managing pensions, and of course, we have regulation to follow.
Mhm, yeah.
We have to make sure that we do our investments in line with the liabilities we have. For instance, if you would have a very old population in your company, and they will all retire within 10 years, then of
Mhm.
course you have a totally different investment portfolio than if you would have a very young population where you know that the first 30, 40 years you don't need to pay anything. So that's a very important element, that your investments need to be aligned with your liabilities.
Mhm.
Asset liability management, it's called. Furthermore, we need to make sure that we have enough diversification. That's part of risk management. Liquidity risk must be under control, currency risk, every risk should be analyzed and should be looked at. So what pension funds do on a tri-annual basis, they do an asset liability management study to find out what their ideal asset allocation would be. And based on that study, they will come up with what we call a statement of investment principle, being or stating something like we will invest between 20 and 60% in bonds, half of it corporate, half of it government bonds. So it are those type of studies and risk management which will determine the asset allocation you're looking for.
Mhm.
And we see lately we have been questioned about all type of investments lately. First of all, it was the transition to a more friendly environmental economy. Then it was the transition to a digital economy.
Mhm.
Today we are questioned to invest in all kind of defense and military equipment. We are asked to invest in infrastructure, and it's not that we cannot do that. Of course we can do that, but we can do that only for a very small bit of our investments, because the whole picture needs to fit, and risk management together with diversification together with, yeah, being respectful for your own principles make that, of course we talk only about small portions of investments. And furthermore, we are not like the Dutch market where you have huge pension funds And often people refer to that market to ask the same from the Belgian pension funds. But our market is only about 45 billion. When we look at the Dutch market, they have pension funds of 45 billion. Their market is about 1600 billion. So they are at a total different level and have, of course, because there I think scale is important, of course, they have much more abilities to invest in all kinds of alternatives. Also, because they are so big, they also have dedicated investment teams. We even don't have personnel within our pension funds. A lot of our investments are outsourced to asset managers, which get, of course, the guidance from the statement of investment principle based on that risk management study and ALM study. But they do the job and they pick the investments, which are, of course, often UCITS and that type of their own products, because they are also there for selling, of course. So yes, we can invest in quite a lot. There is no limit, I would say, but our prudential regulation and the fact that we are investing pension money from our employees makes that we have to stay prudent.
Of course, yeah.
But prudent does not always say that we can't take any risk. No, we have to take risk to make sure that in the end the pension is there at a reasonable cost, but it's controlled risk.
Yeah,
and that's
absolutely.
very important. Yeah.
Absolutely. So a couple questions to follow up on this initial question on asset allocation. There is a legal minimum guarantee. Does this apply to pension funds or is this only for insurance products?
No, it applies for the whole second pillar, although I have to say the percentage of 2.5, because since the 1st of January it's at 2.5, applies for employees. For self-employed, the minimum guarantee, the legal minimum guarantee is that you need to at least to give back the contribution, so that's a zero return.
Okay, as in terms of the minimum.
Yeah.
And
Yeah.
so this is applied each year, or is this applied over like an average duration of 10 years, 20 years? Like obviously the years where you were as minus 13%, like what happens if the legal minimum guarantee is like 175 or 2.5? Like what happens then?
Nothing happens because it doesn't matter. It only matters when you're leaving, where your
Yes.
money is leaving the pension fund.
Okay, so at that point, if somebody retires, we do the math and we give that person at least those legal minimum.
Yeah.
So it would be
Yeah.
like 1.75 for the past 2 years, and then this year is 2.5, and this adds up to all the contributions.
Yeah,
And then
indeed.
we calculate how much they get.
Although there are different methodologies, but
Okay.
indeed for a pension fund, it's like you say.
Okay.
But and now I'm really going into the technicalities, but I'm afraid you're asking for it. So in the legal minimum return, you have a horizontal method and you have a vertical method. And the vertical method, that's the method which is applied by the pension funds, which means that if there is a change in legal minimum guarantee, that as from the moment that there is a change, and like we had at the 1st of January, so previously it was 1.75, as of the 1st of January, it's 2.5. Well, what does a pension fund do? As it became 2.5 as of 1st of January, that means that as of 1st of January, we will count 2.5 on the stock and 2.5 on the new contributions. An insurer is looking totally different at it. And that's because of the fact that he is thinking in terms of insurance.
Mm-hmm.
He says, I have to give 1.75 on my whole stock and on the current level of the future premiums until the end of the contract. And I will give 2.5 on the increase of the premiums.
Oh.
Until the end of the contract.
So it's easier for them. I mean, in this case,
Yeah, it depends. It's
depends. 'Cause
sometimes
if it
it's
goes up, it's easier for
yeah,
them. If it goes
yeah,
down, it's harder.
indeed. Yeah, yeah, indeed.
Okay,
Yeah,
so it depends on what was committed.
yeah. And that's linked to the type of engagement you take.
Mm-hmm.
In a pension fund, we say we do not have an engagement of results. How do you call that in English? We make a best effort engagement.
Mm-hmm. Yes.
An insurer, he promises a result.
Yeah, yeah. So it's different. Yeah.
And that's very different.
Mm-hmm.
That's
Yes.
also that also explains why a pension fund can never become insolvent. Because we don't promise anything.
That's right. Well, I mean, apart from the legal minimum guarantee, so if for whatever reason the legal minimum guarantee goes to 5% and we're not able to match that with investments over a certain period of time, at some point, that's not going to happen because the legal minimum guarantee doesn't go that high, I guess.
No, he is limited at 3.75. So it's linked to the
Okay,
OLOs,
that's good.
OLOs over 10 years.
Yeah.
There is an average over the last 24 months. There is a minimum of 1.75 and a maximum of 3.25.
Mm-hmm. Okay.
So the 5% doesn't happen. But if the minimum return is not made by or respected by the investments, then the employer gets an additional bill.
That's right. So the
And
risk is borne by the employer.
yeah, and be careful because
Partly.
sometimes that is very misunderstood. It's not because you take an insurance that you don't have any liability anymore as an employer. For a pension fund, it's clear. The employer is always keeping the liability
Yeah.
and keeping the risk, but that's his own choice. In an insurance, often he thinks that he has shifted his full risk to the insurer, but if the insurer is not guaranteeing the legal minimum return, of course, there is also a risk that the tariffication of the insurer, like it's applicable in branch 21, with the profit sharing on top, doesn't fit the legal minimum guarantee over the
Mm-hmm.
long term. And
Mm-hmm.
then the additional bill also comes the insurer
Mm-hmm.
to the sponsor and to the
Yes.
employer. So an employer not always realize that there is only that the risk is only partly shifted
Yeah.
to the insurer.
Yeah, I think there's like that was my understanding before. So the fact that you're clarifying this here, it's important because I
Yeah,
can imagine employers having that perception as well, because that's sort of what's commonly said. And I think that's what we read on different pages on the internet. So I guess that needs to be clarified.
that's a very difficult element of the second pillar, I believe. And that's also a reason why I believe many employers are really afraid of the second pillar
Mm-hmm.
because they
There's a
do
liability.
not know upfront what exactly the cost will be.
It requires a good level of financial
Yeah,
understanding and literacy and of the markets, right?
yeah, it,
To decide to go for a pension fund as an employer and decide, yes, I will try to basically get better results for my employees, provide them with better pensions, and I will take potentially a bigger responsibility in doing so. It requires good knowledge. Instead of saying, I'm just going to outsource this out, the risk is away, partly. Yeah, I think it requires a certain level of understanding. So my understanding now is like, okay, these funds are collective, right? So it's the same fund for all the employees, which there might be different funds for different categories, I guess, something like that.
yeah,
It'll be lumped, like there will be collective. It's not like one asset allocation for each individual.
no,
So, which then leads to yes, the decision on where to invest the money and how to invest it based on the average time to retirement, in fact, for many of them, and the fact that the payment is done as a lump sum, not as a drip out or as a distribution on a regular basis. And lump sum payments will heavily depend on the market conditions at that time. So giving a pension retirement lump sum to someone in 2008 is very different than doing so in 2006. And it's just bad luck that it was 2008 compared to 2006, which is why then having this fairly balanced and maybe then on the conservative side a little bit, which is the right thing to do because of that risk, makes sense. Does that because I'm trying to understand why do we have so much bonds, of course. And I think from looking at it this way now I understand better.
I do not totally agree with what you say.
Probably I have it wrong.
Indeed there is a risk or there is a difference between picking up your lump sum in 2006 or in 2008. Yes, I fully agree. But of course, you don't need your lump sum immediately in total.
Okay.
You will invest it. I hope you will invest it.
Yeah,
You
yeah.
you don't put it in your cupboard at home.
But I don't know what we
So
can do with it, to be honest. So I
yeah.
don't.
So if you get your lump sum and you cross the street and you go to invest it immediately,
Yeah,
then it doesn't make any
I
difference.
agree. That's
But of
ideal.
course, the individual need to realize that he has to invest it immediately, and especially in those situations where the markets are in bad weather.
Mhm. And I'm guessing that's quite difficult to do, especially at the bottom of the market.
Yeah,
And because my understanding is that there's very little annuity payment, it's mostly lump sum. I think that's, it shifts all of a sudden. There's a big chunk of money that arrives on the hands of someone who may not have needed to think about this in the past. And then all of a sudden, big amounts, big stakes, markets probably going down, or it looks like it might have. So there's certain cohorts who are just a bit unlucky because it's easier to invest in 2007 or six when it's still going up. You'd be like, oh, I've got this money, I've got my other thing, I can put it back in. It's
yeah.
fairly easy.
Of course, we have to understand that today, and we hope that it will change in the future, but today, not that many people have big amounts from the second pillar.
It's true.
Eh?
Yes.
There was a study in 21, a study made by Sigedis, who is managing the database for second pillar pensions, which has shown that about 24% has a decent second pillar. And for them, the lump sums may be quite important and they could have that situation. But if only 24% has a decent second pillar, there is quite a lot of people where the second pillar is still
Mhm.
or nothing at all. That's for 40% of them, or 36% of them has contribution rates which are below the 3%, which we regard as an absolute minimum.
Mhm.
So
Yeah. In those
that's
cases,
one thing, and that's one thing. So only 24% has a decent second pillar, and that also explains why it's not that easy today to make the switch to annuity payments. I
Mhm.
personally, and I have to be careful, as Ann Verlinden, I can say I personally, but as PensioPlus, I don't dare to make any statement here.
Mhm.
But I personally think that if you want to be taken seriously as a pension system, you need to think about annuity payments. But of course, as long as we notice that the median reserve in
Mhm.
occupational pension is €3,000,
Mhm.
hello, that's
Yeah, there's
just
no
enough
point.
money to buy one coffee at retirement. So, and in a month,
Yeah.
you know.
Yeah.
So, I think first we need to make sure that we have a
Mhm.
decent second pillar, and then we can go to annuities.
Yeah.
And if I say, as Ann Verlinde, I'm for annuity payments, I also need to add to it that I have a lot of sympathy for all those people who want to have their lump sum,
Yes.
because we are living in Belgium. We are living in a country where there are budgetary constraints. We need, or we, I think we don't believe that taxes will go down. They will evolve in one way or another. So people don't trust their government.
Mhm.
They really are afraid that government will increase taxes. And of course, it's easier to tax an annuity than to tax a lump sum, because a lump sum, you can spend it, you can invest it, you can give it away, you can make sure that you avoid the taxes. Another element which is very important for the Belgian employees is, and I don't know why, because of course it's pension money, it's meant to have a good life after retirement, but people want to give it away to their children. So
Yeah.
there are a few reasons why we will not immediately get rid of the lump sum.
Yeah, and I think getting rid of it might not be the solution, but having both options. But at the same time, with the explanation and the context you've given us here, it makes sense that there's at the moment there's just not much offer or demand for it, in fact, because most most pension most occupational pensions reserves are so low, so it doesn't make sense to move that into annuity. And from there, it means that there's probably some offers, but they're probably expensive because there's no economies of scale, and from there it doesn't make them interesting, and so there's probably and so it makes no sense to even go for them right now. And as you said, then the work is we increase the reserves for people with, hopefully some of the work of the new government, which we can touch on upon later. And then when there is enough reserves and people are getting bigger lump sums and that they want it as an annuity, then hopefully then that becomes and develops on its own because there will be a demand for it.
But I think there is a say for making sure, and because there are incentives to accrue occupational pension, I think there is a say to make sure that at least you need to take an annuity, for instance, as of age, I don't know, 70 or whatever, when you have more expenditure in the context of healthcare, in the context of an elderly home. But indeed, I think we need flexibility. We need to make sure that people have the feeling that they have a say over their own money, because in the end, it's a salary component.
Yes, yes.
So some people have sacrificed salary increase for it. So it's their money. They should be able to determine how to organize it and how to spend it. And we see that we do not have to be afraid that all retirees will immediately buy a Lamborghini or whatever. That's not the case. But they are just putting it on the savings account, which is not very fruitful neither. I think at least they have at least 10, 50 years to further invest it. And of course, there we can play a role in the future. But again, we are not there yet. We first have to solve the issue that today the occupational pension in Belgium should become more mature and should be decent for everyone.
Absolutely. And I guess that leads to the next question, which is how do we achieve that? And there's two parts to my question. One is what you believe is needed. Well, actually three parts. What we are seeing from the new government and their announcements. And the last one is on the actual investment strategy in those pension funds. And I guess we can touch that one maybe afterwards. Let's go with what you believe is currently needed in terms of making sure those pillar two occupational plans are, big enough to allow people to have decent retirement. And then how far has the current government gone in terms of announcements?
I want to start with the first pillar,
Yes,
because the criticism I often hear is, why spending money in occupational pension? Why not just increasing the social security contributions and making sure that the first pillar becomes more important? And there my answer mostly is, well, the first pillar, of course, has its merits, no doubt about that. But it also has its challenges. And the biggest challenge for the first pillar, for me, and perhaps Pierre de Voller has touched upon it Monday,
yes.
knowing him, he will have talked about these elements as well. So there are two extremely important demographic challenges. First of all, we are with less active persons to pay for the current pensioners, because that's the situation in a distribution system. The current actives are paying, or their social contributions are paying for the current pensioners. In the 70s, I believe we still had 4 active persons for 1 pensioner. Today, it's only 3, and by 27, we will have only 2 by active persons by 1 pensioner. So you feel that, that system is not sustainable on the longer term. We already notice today that just the social contributions, social security contributions, are not enough to pay for the social security benefits of today. We already see a gap of 6.2 billion. So that's a first element. A second element, and that's very positive, but in pensions it's very expensive, we all live longer. And that's substantially longer. I have the figures somewhere, and I'm going to read them because I don't know them by heart. A 65-year-old man in 92 had a life expectancy of 14. Today, 18, or almost 19. So that's 32% higher.
Mhm.
By 2007, again 30% higher. They will live 24.55. So that's almost 25 years. So the fact that you have to pay the pension longer makes it immediately much more expensive. And that's in a distribution system where the population who is responsible for the bill is getting smaller.
Yeah.
So we cannot expect more from the first pillar. I think it's all already a big challenge to make it equitable. So that's the first remark. And that's a very important remark, especially to social partners, because, it's of course ideologically linked. But often you hear the question, just increase the first pillar. For us, that's not a solution. We really believe that you have to complement, you do not have to replace. That's something else. That's not what we're pleading for, but that you have to complement the first pillar. And how can you do that? I think the advantage of putting a capitalization system on top is that you're talking about a system which has totally other vulnerabilities. We already talked about market volatility. That's something you don't have in the first pillar. You have it in the second pillar. But on the other hand, in the second pillar, you don't have that demographic risk, because in the second pillar, every euro you pay on your account is for yourself. So there is no funding issue, and there is no link between generations. So the risks of the system are totally different, which I believe, and together with me, luckily, a lot of other people also, makes the combination stronger. So our landscape, the landscape we have in Belgium, is a very good landscape. The fact that we have a first pillar and a second pillar with totally different risks, and the combination of those two, and then a third pillar on top, because the individual can also save for himself, which has other advantages as well, makes that we have a very strong system, theoretically system in Belgium, but we don't use the second and the third pillar enough. So I think it's very important that we convince people that that second pillar is not a threat for the first pillar, but that it's a solution for the difficulties in the first pillar. If everyone would be convinced about that message, we can build on it. And therefore, we as PensioPlus advocated for at least a minimum contribution of 3% for everyone, but every employee in Belgium in the second pillar. That has been taken over in the coalition agreement, but to be honest, it was also in the coalition agreement of the Vivaldi government. The problem there was that they couldn't force it at that moment in time because minds were not yet there, and that they asked the social partners to have a study about it. They didn't do that. Of course, the social partners, or some of the social partners, are exactly those persons who believe that the first pillar can be or should be the solution. Today, the coalition agreement mentions that it will be an obligation to install an occupational pension system with a minimum contribution of 3%. And in the text which we saw end of August, there was that it could be financed out the wage norm. Today, that part has been deleted in the text. So the obligation is there that there should be a minimum contribution of 3%, but the way to finance that 3% has disappeared. So I think luckily, social partners have now the task to look how they can tackle the wage norm and how they can tackle the automatic index mechanism in Belgium. And to be honest, I think that there the solution should be found, because there you can try to find a win-win between employers' views and employees' views to make sure that that 3% is funded. But I think that's now the biggest challenge. The obligation is there, but how will we finance it? And of course, at the moment where quite a lot of industries are yelling that wages are far too high in Belgium, that there are a lot of difficulties in the industry due to the energy prices. We have a very difficult geopolitical situation. Of course, it's not the ideal moment to come to a compromise to fund it there. And also be aware that social partners do not have are not used to make agreements on the longer term. They are there to make agreements on the wage increases for the next 2 years. But of course, here about if we talk about pensions, it's not about the next 2 years, it's about the next 40 or 45 years. So it's a mind shift as well to see how they can tackle it. There we make a call to the social partners to mobilize them to think long term and to not only give a solution to the cry for more purchase power today, but to also think about a solution to protect the employees and to give purchase power after retirement. So but they are not used to it. They are really just used to make agreements about wage increases for the next 2 years, and which was decided recently that for 25-26 it will be zero. And I can understand due to the situation that it is zero, but zero is far away from 3%. So yeah, there are quite a lot of challenges, and we are living in challenging times. I can't predict if it will succeed, but I hope we can convince social partners to make work of it, and I hope that we can convince them to make a mechanism that allows us to come to those 3% in 5 years, 6 years. I think the government coalition agreement talks about by 2035, if I have read it well. So there is still some time, but I hope that they create a mechanism to get there, even if it's hard today, that they come to an agreement like X% of the salary increase will automatically go to fund the 3%, or X% of the indexation will go automatically to fund the 3%, so that we can get there. But there is really still a long way to go.
Listening to you, I can only imagine the size of the obstacles and the challenge ahead. When I read your notes earlier and we discussed it, it's like, oh, all you have to do is go from 1 to 2%, then from 2 to 3%, easy. And now listening to you, I
Yeah,
think
yeah.
wait, no, not easy, because right now it's 0%, and even
It's
it's hard. So yeah, it's
even if you know what is needed, and that's something I learned in doing the work like I do these days for PensioPlus. It's not because you know what needs to be done
Mhm,
that you can immediately realize it, because
mhm.
you need a whole bunch of people to convince them, and secondly, to call them to action.
Because it goes against their own short-term interests,
Yeah,
right? The industry doesn't want to increase the wages. The social partners and the workers, they just want to have more purchasing power today.
yeah,
And those none of these two align with the need to increase the contribution to Pillar Two pension plans. So it's like they're actually opposed as of that's their position. They're sort of
yeah.
against, despite there being clear benefits. It's just that their challenges are today, and we're talking about benefits in years. So it's difficult, I can imagine. So first of all, I have a lot of empathy for you, for the work you do, and for the fight that you're fighting, because it's needed. And so thank you for the work you're doing. I wanted to ask you, related to this, so with the idea of improving the benefits, improving the pension payments, in fact, one of my questions was related to the investment strategy of pension funds. And the basic question is, are all investment strategies active investment strategies, so active management of the investments, or are there also pension funds that are following a more passive, like index investing approach?
I think most of them are following a passive approach because they simply do not have the resources to. It's not like in the Netherlands where you have big investment teams who are really directly investing in all kind of equity positions. No, often it's a passive approach. They are following an index or they are simply investing in ETFs. That's what we notice a lot. Yeah, I'm convinced that there is not that much of active investing
So,
anymore.
so I understand that on the from the side of the board of those pension funds, there's no active management. But the asset managers that are working behind, so the ones managing the actual investments, aren't those mostly active managers? Because that's my understanding.
Mostly, no, no, that really has changed over time.
Okay,
Yeah,
so what
I
are
I'm
what are
not
the yeah
I'm not saying that there are none. That's
no
not
no
what I'm saying. But again, that's part of that statement of investment principle, eh?
yes
And that's of course where the board plays quite a role because it's also a bit about belief, eh? It's not only about cost, it's also about do you believe that active management really generates alpha?
yes.
That's the question. But to be honest, lately we have seen that there has been quite a lot of them who shifted to passive management. Yeah,
And the asset managers then are who? They're like the usual
the
investment
usual
banks in Belgium?
suspects, JP Morgan, Candriam, BNP, but also the BlackRocks,
Okay,
name
so
them
so
quite a lot.
there are pension funds investing in ETFs from
Yeah,
BlackRock directly with
yeah,
the iShare products.
yeah,
Okay. So that's very news. That's news to me, because I had the impression that most of these funds were actively managed, going to banks like the Grove. Well, we're not gonna name names, but basically all of them also have active products, which tend to be more expensive, and over the long term they don't do as well as a
yeah.
simple index fund. And my understanding was that we didn't see this shift yet, but you're telling me that
Yeah, yeah, we have seen
the
it. We
shift.
have seen it definitely during the quantitative easing period,
Yeah.
definitely, but even before already.
And so do we also see then a reduction in costs of management of those pension funds by those asset managers?
Yeah, yeah, because active management is very costly. Yeah,
So
and
what kind
that's
of cost are we
that's a
talking about? Do you know?
oh, that's difficult to put a figure on it because of course that's very linked to the mandate they have, eh? If it's in bonds, if it's in
Yeah,
equity,
of
if it's in
course.
alternatives. So I don't dare to put a figure on that, because not because I don't want to, but because I don't have that information on
I
top of
understand.
my mind.
And this is something that is maybe part of the survey you do, or that's Segidis has as part of the database for Pillar 2 pension?
No, because that's really information. I think recently there has been a European reporting on costs, perhaps, which can take it. And there also has been a study by our control authorities, because the previous government has asked for a study to compare the costs in the second and the third pillar.
Ah, yes, the study
And,
was
and
published
that's
recently, right? Uh,
that's sorry?
is that so? That was published by the FSMA.
Yeah, yeah, indeed. And there you can see that pension funds, I think on average, came to a cost of 0.52%.
0.52. Okay.
Yeah, on average, eh? Be
Yes.
careful. Eh? But that doesn't show exactly which investments are behind.
Yeah. No.
But on average, that's the cost of a pension fund.
Well, that's better than I expected. That's good.
Yeah, that's very competitive, of course, but that's also again linked to the way we operate.
Mhm, yeah, of course, as a non-profit, in fact.
It's a bit doing by yourself, eh?
Yes.
No marketing, no selling. We don't sell anything. That's very important. We don't need distribution channels. We don't have marketing brochures. We don't have shareholders, also
Mhm.
important. So yeah, that makes that a very big part of the return you get from the asset manager immediately goes to the member.
Yes, and there's a small portion for just running the operations,
Yeah. Yeah, of course, and
the
the
board.
compliance officer and risk manager, and there are quite a lot of functions to make it happen.
Yeah.
And of course, that has a cost.
Mhm.
But yeah, it's a, as we try to organize it, the board is in full control. That's the engine of the pension fund. As the board tries to organize it in the most effective way, yeah, that all is also reflected in costs, of course.
Mhm. Okay. Okay, that's very interesting. And this is very interesting. I didn't know, so I discovered. This has been fascinating. I think I've asked you all my questions. In fact, we've talked about many subjects beyond what we had initially planned on doing. And I thank you for sharing your knowledge like this. I think this would be a good time to see if there's questions from the audience. I know that there were some questions in the chat. Maybe we can check that now. I guess maybe before we do that, I see that there's still 70 people in the audience. I would love for everyone to join me in thanking Anne for her generosity in terms of time and sharing her knowledge. If you don't mind even turning on your camera, turning on your microphone, if you want to say thank you, this is a perfect time, especially for all the work that Anne and her team and all the pension funds, in fact, are doing for employees and savers. It's really amazing. We have Rakesh here. Hi, Rakesh.
Hello, hi. Thank you, Anne. Thank you so much.
It was my pleasure.
Everyone, if you want to join, it's a good time to say thank you, and then we'll do the questions. I see there's a lot of thank you also in the chat already. But yeah, I guess a lot of people are quite shy. Rakesh is someone I know, so he's comfortable saying hi and saying thank you. That's nice. Okay, keep going with the thank yous in the chat, no problem. Let's go over the questions. I think Raymond was keeping track of some of the questions. I know that there's one question of someone, maybe Rakesh directly, I don't know, asking what happens to my pension fund if I move away abroad into my home country, for example. Was that your question, Rakesh?
Well, not specifically for a pension fund, but pensions in general, also the state pension.
Okay.
Oh, it depends a bit. First, the state pension. If you're moving in the European Union, I know that there is an agreement amongst the member states of the European Union that social security benefits are protected, so that you don't lose the years you worked in Belgium, for instance, if you move to France or to the Netherlands or wherever. So there are mutual agreements across Europe. be honest, I'm not very expert on first pillar. That's all
My
I can.
question was slightly different. I'm not referring so much to the years that I worked. I expect at some point to start receiving a Belgian pension while I'm still living in Belgium. So it's not the calculation of the initial pension that I'm asking about. That's visible on my mypension.be. But my question is that if after, let's say, after 5 or 10 years of starting to receive the pension, if I then move abroad outside the European Union, does that make any difference, or will they still continue to put it in my Belgian bank account?
I would think it would be the latter, but to be honest, I'm not an expert on this. But I think you have the right to a benefit from the Belgian Social Security. It's not because you move that you lose that right. So I
Okay.
would expect that you keep that benefit. Yeah.
Okay. Okay. Thank you.
And we have a question from Tina. Is the contribution by the employer always based on the percentage of your salary?
No, I think I tried to explain that there are different types of pension plans. So if the contribution is based on your salary, we are talking about a defined contribution plan. And I think the name explains that that's a type of plan where, yeah, the contribution is defined as a percentage of the salary. At a certain moment in time, I was also referring to a defined benefit plan. That's a total different type of plan where not the contribution is fixed, but where the benefit at retirement age is fixed. And then, of course, you have a plan like I, as employer, I am promising you that at retirement age, you will get 60% of your final salary. Those are very rich plans, but in the past they existed. Then, of course, market conditions and other type of assumptions will influence the contribution rate on the salary. But often there we are talking about the type of plan or the formula I'm referring to are plans which are very costly and they can exceed the 10% contribution on salary. Of course, there are also, but again, that's rather technical to explain, there are also different funding methods to make sure, because such a type of plan, if you don't take any proactive funding approach, that would mean that the cost of that plan would be very, very low in the beginning, but very, very high at the end of the career. And to avoid that, often those type of plans are pre-funded and taking it into account future salary projections to make sure that there is a kind of stable contribution rate and that employers are not confronted with very, very high contributions at the end of career and very costly pension plans. But that's behind the scenes. Those contribution rates are part of the funding policy of the plan and are rarely communicated to the individual because the individual has a certain promise, which is the benefit at retirement age. And that has no link for the employee with the contribution.
Okay, thank you. Another couple questions from Tina, which I think, the answer is very straightforward, but does the benefit include indexation, and are pension plans protected from inflation? Obviously.
Does the benefit include indexation? If you are talking about the DC plan, no. Except then that legal minimum guarantee, there you could say that perhaps that's a kind of inflation protection, a kind of, but not always one-to-one. So no, for a DC plan. And although I can say perhaps partly because as salaries in Belgium are automatically indexed until now, I don't know what the future will bring. Of course, 3% of your salary is then increasing as your contribution is then increasing because your salary is increasing and automatically indexed. But that doesn't give you a full protection against inflation. But we are better protected than pure DC plans in other countries because of the legal minimum guarantee and because of the automatic indexation of the salaries. But I do not think that you can call that a full protection against inflation. Of course, it also depends on the return you realize on the benefits. In a DB type of plan, and those rich plans I was referring to, where the benefit is, or where the promise is, you get X% of your final pay, again, as we have in Belgium salary indexation, final pay is indexed, so there you have a protection against inflation. So it depends a bit on the type of plan. On top, if, for instance, the plan is saying it's rare, but it exists, I'm paying you in the form of annuity, not every plan foresees an indexation of that annuity after retirement. You not only have the protection against inflation before retirement, you also have to look after retirement. So it depends on the plan.
Thank you. Thank you. There's a lot of other questions. They're quite complicated, but let's go with those. So Tail is someone in the community who is looking to influence what Pillar 2 products his employer is using for the employees, so for himself and for everyone else. And he's currently looking at EasyVest. EasyVest is an index investing management company. They have a lot of pension products for self-employed, and they have recently launched, I believe, a pension fund also for Pillar 2. And he's asking quite complex questions here, but I was wondering, I guess, just getting, I mean, are you familiar with EasyVest and their new funds? And well, like, what's your take on it, I guess?
It's difficult to answer that type of questions for me because I have to stay independent from every member of PensioPlus. So I prefer not to answer in public. But if there are general questions, of course, I'm happy to take them.
Okay. I think another question from Tail is, if scale is so important in order to bring down cost, I guess, why not make one fund for all employees instead of a separate fund for each employer?
That's a very good question, and that's a very political question. I think we as PensioPlus are not for one big fund, because there have been member states in the EU where they have chosen that option. And of course, if a member state is under strain through to budgetary questions, there is always the risk that the pension fund is nationalized to pay certain bills. That happened in the past in Belgium as well. And therefore, we think it's rather risky to create one big fund. We prefer a fragmented approach, but perhaps less fragmented as what we have today.
Very interesting. Thank you for that.
Yeah.
And one more question from Tail. What is the tax advantage of Pillar 2 funds or insurances? I think it's the tax deduction.
The tax advantage.
Yes, sorry, tax advantage. Sorry.
The tax advantage for the individual or for the employer? For the employer, the incentive for an employer to organize an occupational pension plan, either in pension fund or group insurance, that's independent from this answer, is that on the premium he contributes to the pension plan, he doesn't pay full social security. He only pays 4.4 insurance tax and 8.86 social security contributions. If you compare that with a normal salary, on a normal salary, an employer pay about 25 to 30% social security contributions. So that's for the employer the incentive to organize an occupational pension plan. For the employee contributions, employer contributions are not taxed. Employee contributions, they do exist, but they are rather rare because employee contributions need to be paid from net pay. That means that the employer has paid 25 to 30% social security contributions, but also the employee has paid his 13% social security contributions, and then you have the deduction of the employee premium. If you pay an employee premium in your second pillar pension plan, then there is a reduction between 30 and 40% of the premium in your personal tax.
Okay, so there are decent incentives at both levels.
Yeah, indeed. So yes, there are very good incentives to save an occupational pension. And we think that's needed, or that's defendable, that's justified, because occupational pensions are really bringing a solution to a societal problem.
Yes.
And as first pillar pensions are not enough to, or for employees at least, perhaps for civil servants in a statutory plan they are, but for employees and self-employed, just first pillar pensions are not high enough to guarantee a decent, accurate pension income.
Okay, yeah, that makes sense. There's a question here from one man. So is there a benefit for a one-man SRL to become a member of PensioPlus? Is there someone who can look at my current pension plan and help me optimize?
An individual becoming a member of PensioPlus? No, only...
This is only for pension funds, right?
Only for pension funds, organizers of an industry-wide pension plan, but that's difficult if you're on your own. And for providers of services to pension funds. Those are the type of members we have. Yeah.
So he would have to go somewhere else to look at his pension, right? I think there are consultants who help with this.
Yeah, indeed.
Okay. Someone is referring to the conversation we had yesterday with Better Finance, in their report they showed that IORP, which are Pillar 2 pension funds, as far as
pension funds,
return a very low real return of 1.3% over the past 20 years, or I think it was 2002 to 2022 or something. How does this compare with the high returns discussed today? And I guess also your data includes the latest years, but there seems to be a disconnect between the figures you've shared with us today and what we've seen yesterday. That's right.
Yeah, the figure I shared today was a figure over 40 years. I think you were mentioning here 2022.
Yeah, from 2002 and 2020.
2002 to 2022.
Yeah, so it's like those 20. I'm not sure if it was 20 years or 24 years because they have
okay. Of course, the period you pick in a sequence can be very important and can give very different figures. So I don't have in mind which figures exactly play a very important role in this period of 2002 to 22, but you already have the 2008 crisis in it. You have the debt crisis in it, and you have 22, which was on its own also a very bad, or a year where financial returns were very low. The period I have taken, and I have not picked a certain moment, but I have taken the largest period possible in the history we have to come to an amount, or to come to a figure of which I believe that is the closest to the return you can expect for a full career. And of course, the longer you have, the more averaged the ups and downs.
It would be good for that report to use the data that you have.
Yeah. I do not understand why they limit for us the period, because why that period? I don't know, perhaps to compare it with other figures.
Based on the data that they have, and my understanding they got data from Asuralia, which is mostly the insurance plans. But I don't know exactly, but I guess this is more of a data question, which makes sense that different periods lead to different averages.
Yeah, of course. And if I can help that person, please go to our website, to the financial survey. There you see the full period and also the return by a year. So I assume that Better Finance probably has used those figures to come to the results. But yeah, you really have to be careful. It's not because I say if you look over the past 40 years, it was on average 6% per annum, that we guarantee on an annual basis a return of 6%. No, that's not the case.
Mm-hmm. That's right. Now, of course,
So it can be very different. Yeah.
Some funds did 4% average of that period. Some others did 8 or 10, maybe. So yeah, it can be very different from fund to fund. This is another question from Tail as well, which I think is very big questions for a lot of people in the community that I lead, which is why would one opt to contribute to second pillar plans if I can get better return investing myself, where I have a better control on the asset allocation, bond stocks, according to my age and my needs?
That's a very individual way of looking at how to organize my pension. And okay, most probably this person is capable to organize it by themselves. So go for it. The advantage of a second pillar is that the system is collective and that you are covering a whole group of people who probably themselves would never come to such investments. I've seen, and that has nothing to do with, or not always to do with financial literacy, but if you ask an individual to organize the pension provision by themselves, what do you notice? You notice, first of all, that they start contributing too late.
Mm-hmm.
We often see that with pension saving plans or saving funds in the third pillar, that people start when the house has been built, when the car was bought, and when the children have studied. Then they start their savings for their pension plan, which is at age 50 or 55. But then it's too late, or then it's too costly. So the advantage of the second pillar is that you start when you start working. If every employer would have a pension plan, that would be the case, and we hope we can evolve to that situation. But that's the aim, that you start early. Very important. A second very important element in the context of saving for your pensions is that you contribute enough. And I think there are not that many persons who realize how much a pension costs. I give you an example. In the context of the government discussions, they wanted to have an extra taxation on lump sums which exceeded the 100,000 euro. And they present the 100,000 euro as if it's a huge pension amount. But 100,000 euro, that's giving you a monthly pension of 333 euros.
Mm-hmm.
Is that considered as being huge if you have only 1,500 from the state's pension? That's a bit exaggerated, but there you notice that people do not realize how much it costs to provide an extra monthly pension. And finally, that's the aim. So contributions are too low. And then thirdly, and we already talked about it, and perhaps it's not in this group because I think you're experts in investing, but many of the people don't dare to take risk and invest in fixed income products. Especially for the younger people, I would say don't do that. Take risk, because that's how you can generate a good pension income at a lower cost. So the combination of these three, too late, too low, and too risk averse, makes that it really is an advantage to organize it in a collective way for most of the people. But I'm convinced that the people I'm talking to today most probably can also do it by themselves.
Yes. So Obviously, we're in a community where we learn to invest on our own, and in fact, we invest better than banks because we can do it at much lower cost. But it also means that we take a huge responsibility, right? Which comes with the responsibility of contributing enough and managing downturns. So the emotional aspect is not easy, even for the more. In fact, it's even harder for the people who feel the most confident because they tend to take risk that maybe is a little bit too much. So it comes with a whole set of competences to be able to do it on its own, which is very far away from what the majority of people can handle. And very few people actually learn this early enough for this to be, at the level of a pension that kicks in when we start working, whether that's at 20 or 25 or what, even 30. A lot of people come to the realization that they need to learn about this. And so I teach basically index investing to a lot of people in Belgium, but most people who actually join are well in their 30s or 40s already, if not more, right? And so it's too late to, well, it's not too late. Of course not, because you can optimize many things with the money you already have, but it's obviously better to start contributing and accumulating much earlier, which the pension plans do, right? So absolutely, it's a solution that works. In fact, it's a brilliant solution that works, that can work for everyone if we could increase contributions, make it fit within all the other constraints, and optimize for efficiency. But as I understand, it's kind of happening also gradually. So that's great to hear. And obviously, yes, the question came from someone who's already managing his own portfolio and has, is not scared of risk. I can tell you, knowing him already. But we learn to manage risk. This is really important as well as index investors. All right, another question. I'm trying to find the most useful. I have worked outside for a number of years outside the European Union. How can I transfer those years to my Belgian pension, if that makes sense?
My philosophy is keep it where it was accrued. And I'm not saying that is always the most optimal way, but often it is. Once you shift reserves from one member state to another, or even from outside the EU to inside the EU, there are really a lot of questions about taxes, about how it is considered, about payment modes, about it that are really that can be very, very complex situations. To be honest, often, not always, but often, keep it where it was accrued is the best solution, because then often you can still benefit from the same tax incentives, from the same accrual, from the same protection. And if you bring it in, if you step out that system and you bring it in elsewhere, there are other rules apply. And if I look to the European Union, even within the European Union, on pensions and on taxes, those are two competences which do not belong to the European Union, but which stay a competence of the member states. It's very difficult to optimize it by combining them. And if you want to do so, please go to a very good tax consultant, pension consultant, to make sure that you don't lose a lot of money.
Thank you. We have one more question, and then, well, actually two. I have a second, last question, but one more question. Do you know the proportion of organizations or employers that are going for pension funds and the proportion that goes for group insurance?
In terms of employers, that's difficult to say. I don't know the answer. But in terms of reserves, vested reserves, 80% is with group insurers and 20% is with pension funds.
Okay. What can we, this is me obviously being in favor of pension funds, but what can we tell employers about how to make this choice?
Do your homework. Really, do your homework. And especially, we already talked about multi-employer funds, especially nowadays that those become very active as well. I think an employer has no excuse anymore to simply go to the group insurer. They really have opportunities, and they really have, there is an offer for them as well. Even if they do not want to be involved every day with the pension funds. So it's the in-between solution. But I think it's better than, I think even that is better than group insurance.
Thank you. And then the last question is, if an employee finds himself or herself in a company where nobody talks about pensions, what can that person do in terms of trying to understand what's there and maybe getting help from outside? Are there people who help people trying to figure this out? And
there is a very good website, Wikifin, from FSMA, with a lot of information. It's written very well and very accessible. And I think there you can find most information. If not, I think you can also call them. And as they are an authority which are responsible for social protection and also consumer protection, I think they are best placed to give the answer to the individual.
Yeah. Okay. So that's because I see a lot of questions that are very personal with, here's what I have in my plans and here's what's going on. Like, how do we help individuals like this? So yeah, I think going to Wikifin is the right move. I wonder, there's also like associations and nonprofits that help people plan for their retirement, right? I don't know if you know any names of those associations, because obviously you're on the industry side, so I don't expect you to have those answers.
Yeah, but I hope, be careful then that it are not brokers or
These are
persons. They need to be independent.
Yes, and the one I know about, they are non-profits, and they basically help people figure out what to expect in their retirement, and they help them with the transition. So they aim at but I don't think they do sell, for example, investment funds and that kind of stuff. They really focus on education. But then again, I might be wrong. And I guess there are also
And
big.
I question if they include second and third pillar.
So I believe they're quite comprehensive, because I was one
Okay.
interviewed on LN24 on the TV, and one of the other persons were in that sector, and they seem to have a full overview for people's situations.
Okay, great.
Yeah. Okay. But that's great. Anne, thank you so much again for your time. Also, it's been almost 2 hours. Actually, it's been more than 2 hours because we started a bit earlier. Everyone, thank you for your incredible questions and for your support. If you could drop another few messages of appreciation in the chat, I will take snapshots and I will share with Anne later so she has a good memory of this event.
I already have a good memory. It was very nice to do. So I wish you all very luck with your pension investments. And if you have further questions, please not hesitate to ask them.
Awesome. Well, thank you so much, Anne. Thank you, everyone. Good night, and see you for the next talks and future events of Fire Belgium.